Looking forward to talking to you, James. I'm making you the presenter now. Looking forward to hearing your voice and seeing your screen, my trading warrior brother. How are you, James?
I'm good. Can you hear me?
Can hear you perfectly, buddy. Nice to meet you.
Good stuff. You too. Thanks very much for having me on. I've been listening to you guys since the start today. Great bits of analysis. Awesome.
Thank you very much. Yeah, it's a team effort here. So you know, I really believe in collaboration. When I was a young guy, James, and you still look like a young guy, the only reason I'd want to know what others were thinking is so I could fade them. But later on, after I had my teeth kicked in a few times, I really learned, and I tweet about this. You know, surround yourself with traders better than you. What do you think of that?
Yeah, I mean, absolutely. I mean, and I've been, although relatively young, but feel about 75. But the fact is, I've been doing it for a long time. But since I was really young, since I was straight out of school, I've been in this the industry, looking at markets. And
that's a great segue. Because you know, I usually ask people, well, tell us about how you got started in the industry and what your journey was like. So how old were you when you started looking at charts in the markets?
16 and 17 was when I first started doing that sort of stuff, and I'm 34 now, so it's it's been a long time, and it's yeah, well, doesn't feel quite like that, but yeah, I get what you mean. But the fact is that when you first start in this sort of stuff, and especially being so young and cocky and thinking that you know everything, and of course the reality to that is you know absolutely zero. So you're always surrounded by people that know more than you. Not that I wanted to accept any of that, of course, especially being at that age. I didn't want to accept that anyone knew more than me. So, well, you know,
you can't learn experience. It only comes with the passing of time and living through things. So who were your influences, James?
Well, it's all been because I've worked within this kind of retail trading industry in London for such a long time now. There was some, and I was a dealer for a long time, working on dealing desks, and sort of back in the and I say early days from my point of view when online,
the wild west days.
Yeah, exactly. Right. But those early days of online trading where people would you trade with a broker and the way those orders would get filled within the market was by me sitting there filling them manually and just clicking the button, going in and finding out. But from those days we had the sort of great heads of trading and things like that who were so many years.
Yeah, you were fortunate to be surrounded by traders at a trading desk that were pros that, you know,
exactly.
They didn't always make money, but you learned how to lose small.
But that's the thing, isn't it? That is what trading is about. It's about learning how to lose your money, and the best traders lose money well, and that's a pearl. That's a pearl. Exactly, and you have to learn that. You'll have to learn that you lose money, and then of course, when I was young, coming into this, looking at charts, and back then markets used to rally. I used to look at a lot of UK stocks, you know. So back then it was all UK stocks. Looking at these individual stock markets and just looking for 52-week highs, you know, looking at 52-week highs that were just going to be free money for you. Go in, look what's made a new 52-week high that day, and sometimes you look what's made a new 52-week high that day in the FTSE 100. Well, there's 25 stocks that have made new 52-week highs, so just lump on them and leave it. And that was kind of the strategy that you ran until you get cocky, and of course the markets don't do what you want to do. And when you're young and the markets were running the way that you wanted them to run, you never feel like the market's ever going to do anything else apart from go your way. And then of course it doesn't, and life becomes harder, and that's when you find out how to lose money.
You're a veteran. Why don't you talk to us a little bit about what you do for risk management? I know a lot of people, they do it based upon a percentage of their account. To me, that doesn't make sense. You know, I want to be out if the contingency that compelled me to take risk is negated. So I'm more of a believer in market stops rather than money stops. So
absolutely, and that's. I mean, it depends, doesn't it? I mean, it depends what sort of account you're running. And I always obviously you run this sort of stuff on percentage ways if you're talking about sort of monetary stops and not wanting to risk too much. And of course you have to absolutely get that way of trading, because in the sort of trading that I've been involved in, and the sort of clients that I'm speaking to a lot, you're talking about sometimes $100 accounts, and it doesn't matter what sort of money you're trading. Not everyone's trading for the same reasons. So the fact is, it doesn't matter what sort of money you're risking on your trades. It doesn't really make any difference from that point of view. You have to make sure that you're looking at what the most important thing is within the market, and of course that most important thing is the price. Price action is what dominates everything. So I think sometimes, if you're saying, the old adage is, of course, you risk 2% of your account. I mean, we've heard that everywhere.
Yeah.
If you're risking more than 2% of an account on a trade, then you're not doing it right. Is how it all supposed to tell you. But of course, I don't necessarily believe that the same way as you, because you need to look at what the market's doing. And the one thing I always try and teach when I'm talking to people these days is that the market is a living, breathing beast. You know, it's not. Yes, there's algos. Yes, there's trading systems that are made, but of course humans are behind those as well. So you've got to give it a little bit of leeway. You've got to be looking at the markets at the right times, and you can't just be as. I'm all for being strict and following trading plans and things like that, but it's not necessarily a case of saying, well, this is my area, this is where I'm coming out. You have to be able to act and shift your opinions as it works. And I'm not talking about moving your stops every 2 seconds and doing the old.
Oh, you mean CIC orders? Do you know what they are?
No, say again. CIC.
Yeah, cancel if close.
Oh yeah, of course, yeah.
For your stops.
Yeah.
So, do you have a dual role at GKFX where you're both an analyst and an educator mentor for their customers?
Yeah, so we do. It's kind of a three-way thing, really. It's a lot of what I do sometimes is pushed out to the media, so TV work and things like that, where we become talking heads. We've all done it. We've all done that kind of stuff where you're a talking head on CNBC and you put yourself up for everyone to call you a moron 25 minutes later all over social media. So we do that side of things. But then there's the case for educating clients, and a lot of what I've done over the years has been sort of talking strategies, talking economics to a certain degree, talking about a lot of the fundamentals, because again, obviously technicals are important, and we look through those, but it's a case of looking at these fundamentals, and from a retail point of view, talking to general average people, everyday people that are wanting to get involved in this. You can sometimes, I think the feeling is, you can learn the charts, you can look at the charts, and the more you look, the better it comes. But the area that a lot of people struggle to understand is the fundamentals. It is what I'm supposed to be looking at. Am I looking at the right content? Am I looking at the right things on the economic calendar? Is this important to my trade? Is that important to my trade? Those sorts of things. So talking through that kind of education, as well as obviously looking at charts and trying to pinpoint certain levels and
okay, well, let's talk DAX. So a lot of people a few months ago got very excited about Europe, and for a period of time it was outperforming the US, but I look at the DAX chart, and DAX topped about 5-6 weeks ago. The Dow didn't top till yesterday. The S&P's made a new high yesterday. So people that have made that bet about wanting to be more long Europe than the US are on the wrong side of it for now. What are you telling your people with what's happened this week, that we're at a new low for a break? Is this a buying opportunity or a breakdown in your view?
Well, I mean, everyone's been trying. The thing you have to, obviously, we all realize is that the fact that everyone has been, a lot of people have been trying to sell equity markets ever since November. You know, been as soon as they jump higher, people try and sell out of them. Almost a typical retail trade is just sell out of that at those tops. But
and one more thing before I forget, James, and could this weakness in DAX be directly attributed to the euro strength and the dollar weakness helping multinationals here, and the 10% move in the euro hurting German companies?
Absolutely, that is partially to do with that. I mean, the DAX is almost becoming the bear's choice now, the seller's choice out there. Everyone wants to get involved somewhere in these equity market moves, but people have really struggled with buying into something which is that has had so much strength. It sounds crazy, but of course, the Dow's been going up for such a long time. People struggle with it going any higher and buying into it and taking it higher. So we've had so many clients from our point of view wanting to sell into something, wanting to. People are fundamentally negative within markets. People are fundamentally negative. They can't get out of it sometimes. So
what would you do with it right here? And you know, there's nothing wrong with the answer of nothing right here. But to me, it looks like we're on the verge. It kind of looks like, with a few lines you have drawn, descending triangle, which is a topping reversal formation, and it would measure pretty good from where we're at now. It's like about 800 points. Yeah,
we've got some pretty big breaks in here, and I think one level here, I'll just zoom in a little bit more. One level that we've broken below, which is kind of this cluster of lows here at 12 about 84s or so, but it's the gap. I mean, and I'm all for these gaps.
Yeah, these gaps today.
Yeah, we've filled that gap and we've broken I like the levels on the break opens and the break closes, you know. So that close of that candle there is a big level, and I think looking at that a daily close on that below that that gap close back here, which is forget the dates. What's that? April 21st, April. So this gap close is an important level for me, and I think if we break in below that, it does open us up to some other areas. Now we've seen some areas of support on the downside around some of these levels. Now I've got the fib in here. It's completely ignored the 23.6 in here from
this area. It's been a very, very orderly decline. Maybe we're about to enter an acceleration phase here. We'll get a little mini panic. To me, it looks like it wants to retrace all the gains we made from the beginning of the year, or after the election, or for
November's
sure.
Are the lows, because
we've already taken out all the gains from the French election. Wasn't that the gap?
Yeah, that was the gap. That was the gap that we're looking at. So that was first round French election issues.
So now we're going for the U.S. election lows.
Exactly. Take out all these elections. This is the way forward. But I think from this point of view, you're looking at pretty aggressive breakouts, but as you say, an orderly move lower. But it's naturally going to be an orderly move lower because everything else, apart from Europe, and of course the FTSE's breaking a little bit as well, with that bit of negativity. But of course, we are looking at. You can't trade that, not look at U.S. equity markets. You can't.
They'll buy dips. People are conditioned to buy dips. They've been rewarded doing it. They're going to buy dips all the way down.
Yeah, exactly, and that makes these areas here. I mean, the areas that we have here, it makes this nice. It makes going back here nice as well, and any breakouts back to a nice trend line that comes in. What it will probably do is lead to a pretty orderly downward trend line, pretty textbook. I mean, I'm not one for keeping to textbooks. I mean, we've all read them, and we all know where they are.
What was your favorite trading book, James? I'm curious.
Well, there's a guy here I know very well. He teaches within the STA, the Society of Technical Analysts. He's called Clive Lambert. He wrote a great book on candlestick charting, and that was he's a good guy.
Was he a Steve Neeson follower? And then he developed his own stuff. Why are you laughing?
Because he'd like to think himself as Steve Neeson, but the number of pages in his book don't necessarily.
Hey James, have you noticed, partner, that there are no egos in this business?
Absolutely, absolutely. And if you start with one, you lose it pretty quickly, or you have it beaten out of you quite quickly. So it's fine. You're asking me, who started at the age of 17, so I've had that beaten.
I have to take this opportunity to announce how proud I am to announce how humble I've become.
Yeah, exactly.
Sorry. And enough of my stand-up routine. So, part of this, besides providing compelling views, actionable ideas, is, I was talking about it before, that sometimes we just take trading too seriously. It's got to be fun too, don't you think?
Yeah, of course. And that's why when I go back to say, look, not everyone's trading for the same reasons. Not everyone's trading because they want to earn a little bit of extra cash, or trading for a living, or doing whatever we think we're doing. Some people are doing it for fun. They're doing it for this. They're doing it for that. So I think, there's two key bits of information, and you said one of them earlier, but when you first started off, which was obviously treating your trading like a business. Don't get too emotionally attached to it, and which is, of course, it's an old piece of advice, but the business side of it is, treat it like a business, treat your trades like a business, look at them like a business, but remember to enjoy the good bits. When you make money, remember to like enjoy that part of it. So there's a guy I know, another guy who's a big mentor of mine, is a guy called Philip Concha. He's a guy who works out of Ireland, owns a company called TraderCast. Now he's running a fairly new company he owns, but I've known him for a very long time. And he always said to me, and again, he trades some big size and massive, and he has quite a lot of followers, but he always said to me, take your profit, go and buy yourself a new shirt, go and buy yourself a new coat.
Because it's not real until you spend it.
Exactly right. And it's really
when you go to a casino, you give them cash, they give you chips. There's a reason for that. The chips aren't real money, and your account is just a bunch of digits until you spend it and feel it.
Exactly.
Great advice.
And I'm all for keeping it in, building up, and building your account up, but take some out and enjoy it. Get yourself something out, and Philip always told me that.
I'm going to have to call the board of directors of GKFX and saying that you're trying to drain their liquidity.
If the withdrawal data goes up, then we could be in for an issue.
James, I'm having a blast with you today. So, God, a lot of great people. Let them know that if they want to come address us, that my mission every day is to build up an edified trader. So, some top guns, I'd be more than willing to interview them here. But let's go on with you. So I think I have a feel for your DAX look. What else is on James Hughes' radar screen?
Yeah, well, I want to show you something a little bit on oil that we've been talking about loads here on the dealing desk. But I actually want to talk about it from the fact of something that didn't work or isn't working at the moment, because I think that's just as important sometimes as the stuff that does. We've been looking at kind of strategies on this for a little while, and how to oil is something that I struggle with a lot of the time. So political. The other word for political is corrupt, but we won't use that word today. But the fact that these markets have rallied strongly, and like I think it was Steve was saying beforehand, he was looking at a turnaround around this $49 level. Same kind of story. We were looking at that, but there's something in this situation. I've got Bollinger Bands on here, and I've got this 8-period average, 8-period daily SMA that runs in here. The color here is not great for you. Hopefully you can see it.
I see it.
So. And this is something that we've used. We've had guys here looking at this. We've got some old prop trader guys that work here as well that have said this 8-day moving average on oil has been a great one. And it's been a fact of very, very simply closing above it, going long, and I'm into simple trades, simple areas to look at, not overcomplicating things. There's so much you can do to literally kill things. But the the breakouts on this have worked nicely, and we've been trying it out and trying to work in it, and breaking above it, running it out, going long on a break above, taking out some of that position on the high of the Bollinger, and then running the rest, you know, so getting that out, taking a stop higher. But then we ran into this situation here that you're looking at, this ugly piece of nothing, which has killed us, really. It's killed us in what we've been looking at. And I think we've been trying to adapt this and see how we're going with it, and see what we can do with it. We've been trying to say, okay, well, maybe we keep within this this trading strategy for a while, but we were keeping very strict, saying close above, run it higher, close below that 8-period average, reverse yourself out and go short. And all fine and great, and sometimes as you can see within this, you catch some big moves on the back of this. Yes, we get some big candle breaks, but you catch big moves on the downside. If you see how often this closes back above this 8-period average, it doesn't in that whole move, this whole move lower. You look at this one, break to the upside, you're taking a lot of profit out. You're hitting the upside, yes. You're taking half of your half or some of your position off on the high of the Bollinger, and it's working nicely. Again, breakouts below, you take some, and it worked nicely until it
ranged.
Until it ranged. But then you look back at oil and how oil trades and what oil is about. It does love to, but I mean, before the last sort of 12 to 18 months, it loved to range. It loved to hit a range and say, okay, well, here's the $5 range. Let's go $35 to $40, and this break out and then go $40 to $45, and until it started to hit something pretty nice. And Steve was saying previously that $49 level was an important one, and we didn't expect it to go through it. Similar with 50, didn't expect to go through that. Similar to this now, we hit a triangle, and the fact that we can sit here and say, okay, well, we know that around this period here, this 8-period moving average situation was just killed us. You know, it's up and down. We're all out of it. But we've looked at, if you look at this now, look at the triangle, how it is. A pretty nice formation of a triangle, then a breakout on the upside on this daily chart, and then looking to maybe run that higher. So within this strategy that we've done, again, if we were running it to a T, which is pretty much killed us, you can see that the days that we're getting really hit. Then we break above, then we move higher and look towards these Bollingers. But this is a key factor of looking at some of these charts and saying,
you know, James, I have a weekly. If you could pull up a weekly on the WTI. I have a couple of technical reasons. You have to go further back to the bottom of last year. Okay, you know, that was a yeah, it was a big falling wedge. It had a throwover, but the wedge line started, I anchored it from 62-ish. So that's kind of, you know, wedges can retrace 100%. But more importantly than that, I'm not sure when the event is going to happen, but I do believe that they'll move heaven and earth to keep oil up until the Saudi Aramco IPO comes off.
Absolutely, yeah, for sure. I mean,
so, I'm not. Do you know when that is?
No, I mean, it's something that's been muted for such a long time now. Yeah. I mean, I've done must be 6-7 TV interviews about this sort of world's largest IPO and all of this stuff, and it's just not. You know, when's the date?
Equity, they'll hold up a market or drive a market up into a big IPO, so it's a great environment for you know, and sentiment is up for people to come in and participate, and I believe that the Saudis will do the same until they off a piece of their business to the public.
Absolutely, and there's also
some bad holders.
Yeah, and there's also a situation, but there's also a situation with oil that the fact you've got these two big contracts, right? You've got the WTI and the ICE traded Brent contract. But the end of this year, also they're looking to run the Shanghai oil contracts. So a third major oil contract in the world. Yes, we've got some Qatari-based oil contracts that don't necessarily that are out there, but they're not well known. Now, Shanghai have been. We know how big they have been in China, offer commodities in China, and the futures market, and of course, you know, the mom and dad traders, the ma and pa traders, as they call it, as it's been dubbed. But you've got this Chinese oil contract is big news and has been brewing for such a long time. Now, expectations are that this oil contract is gonna run and come into play at some point within within this year, so towards the end of the year. And there's this feeling as well that of course oil prices, they want oil prices to be higher for, yes, the Saudi Aramco IPO, but of course if China are launching such a big contract, which they want to be as big as the Brent and WTI, they want it to be a third major contract in the world. To run that, they don't want prices down at sort of $30, or they don't want downside, and it's a very political, PR driven reason, as they don't want that, because they don't, investors from in China. The big situation that they've spoken about is the fact that it's the very negative connotations of launching something which is incredibly negative, is incredibly low, and isn't moving up. So there is that feeling as well of trading on the launch of this. They want this oil price above $50, closing in on $60 for the launch of this, which is, I mean, I don't know how much power they will have to do that, but there is coercion in terms of how they get that trading to the upside. But with the Aramco situation as well, and this is what I said previously about oil, it's so much.
While we're focused on North Korea, they could always create some problems in the Strait of Hormuz for that to happen. I'm looking at the fact that you and I our main bailiwick niche is currencies, and I've asked a lot of people this question, James. I'd be interested in your view. Of course, we all know the dollar peaked at basis Dixie at 104. We've had this big break down towards this 92-ish area, trying to recover. What camp are you in? Is this just a correction in the dollar in an ongoing bull market, or have we had a secular turn in the dollar and there are much lower levels down the road, a new bear market in the dollar?
Yeah, I mean, I think it's really, we've got real negativity, I think, and it's long term as well, I think. And I think if you look at the downside, I haven't got a Dixie chart on.
How about Euro? I mean, it's almost the same chart turned up.
Yeah, it's almost exactly the same. Yeah, exactly. Yeah. So, but apart from the sell-off from the payrolls last week, the jobs report last week, there is very, very little which gives you any real excitement around any sort of dollar upside, I would say.
Yeah. Okay.
I mean, and I think from a Fed point of view, you have to look from a Fed point of view. The unwinding of the balance sheet, yes, but also the fact that Janet Yellen's kind of on borrowed time here. We're all pretty sure that she's not going to be there for too much longer. Donald Trump will have his way, I imagine, and have someone in there that he wants there. But the worry I have from a Fed point of view as well, and I think maybe this kind of ties in to that degree, is look at what we've got in these markets. You've got rallying. You've got a hawkish Fed. You've got a negative US dollar and rallying equity markets. Now, it doesn't make any sense, right? It doesn't make any sense. And the fact that the Fed is looking to unwind this enormous balance sheet, is looking to continue to, and we've really focused on the fact that there's there's going to be no more rate hikes until pretty much maybe December, even though that's dipping down now. But we've focused on that. But the fact that they're unwinding this balance sheet is more important. But they're unwinding the balance sheet on the fact that Donald Trump and his administration have this fiscal and tax policy that supposedly is coming into play. But this must be such a big question mark around that. And whether that can be put through, or whether Donald Trump can push anything through at all. You've got a monetary policy which is being run all on the back of a fiscal policy which is not even in its infancy. It's not even anywhere near being passed anywhere. So
your point being, without any fiscal stimulus, the handoff from central bankers to the government with deficit spending, if that doesn't happen, the Fed is, even if they're not aggressively tightening, just unwinding their balance sheet's going to be deflationary.
Yes, exactly right. You have to have that other side. Yes, the US economy is performing well. Yes, it's got a particularly it's done particularly well, and we know the US economy can support what we've had so far in terms of the tightening by the Fed. But the fact is that the Fed are acting, and their future projections are all there on the basis of this fiscal stimulus which is coming in, and it just my worry is it won't happen, and that's
buy dips in the euro, right, James? Do you have any upside? You have any upside targets for the euro? I mean, if you just take it from the 140 high to 103, this could still be considered, 125 or so would be halfway back or something like that.
Yeah, I mean, I think you have to look. You have to look towards these. There's real. It's kind of impossible to kind of grab any levels up here, isn't it? I mean, you can put some fib moves on there, but I think this was interesting break. This is the interesting situation we've got at the moment for euro on the weekly. Is this 200 period average? It doesn't like it. At the moment, you can see there's clear rejection of that figure. So that worries me to a certain degree.
I'd love a break. I'd love a break towards 115, 116 to buy it.
Yeah, for sure. I mean, back down to that 116, that previous week low is a nice area for us. But I don't think you can look really past the fact that any dips down on this are key opportunities.
So let me do this now, James. You work, if you'd like, you could show the website and the FX company you work for, where people could find your research. I have your Twitter handle at James_Hughes UK on Twitter. So
that's the one. And this is our we have obviously GKFX. This is the UK site, is a .com site as well. So by all means, but we also at GKFX we have a market insight. This is our kind of research page where you can see our research. There's videos done by myself, by interview a guy you made. Peter Tuchman, we interview him every week. We do some various different educational videos and various different points. So by all means, feel free to.
You guys are only missing one thing: a live social trading community.
Absolutely.
You guys should sponsor a webinar. Just planting a seed. That's all. Planting a seed. But so I see you, James. I'm so glad I reached out to you on Twitter. I have a knowing when I talk to somebody if they know, and you're one. So I want to thank you so much for your time and us being able to talk about the psychology of the business together, and for providing some of your views. And from here on out, I'd like to call you my trading warrior brother. Do you accept it?
Perfect. I absolutely accept it. It's been an absolute pleasure. Thank you very much for reaching out. Thanks for having me on, and whenever you need me again, I am more than happy and willing to be your trading brother.
Well, thank you so much, James. May pips rain down on you and everyone that reads your reports and sees your writings. Okay, buddy?
Thank you very much, Dale. Hope to speak to you soon.
Okay, thank you, James and F.A.C.E. Hope you had a good day. Investing.com. Hope you enjoyed our webinar. It's the best social trading community on the net, in my extremely accurate and humble opinion. I'll see everyone tomorrow. I believe tomorrow's Friday. Good hunting. Hope that you caught pips on silver from Nick's harmonic call early this week, and the guys are working hard for you. And I tweet this out: you don't have to be a prisoner to your workstation or your laptop when you join, or even take the trial. You could download the phone app and go about your life like Greg was talking about. It's not just your account balance. If you want to go out and buy a shirt, you could take your device with you, and you'll have all of our analysis wherever you go. So have a great day. Most of all, don't just count your pips, count your blessings. See everyone for TGIF. And I want to thank James Hughes one more time. Adios, my trading warrior brothers and sisters. See you tomorrow. You're very welcome, JC. You're welcome, Bill. Nice to meet you. Adios.